Hi, this is Kerry Artak with Artak Advisory, and this is the weekly AgriTalk video supplement for Monday's show, July 19th, in which I cover December corn, September crude oil, and mostly October live cattle, but I'm going to throw a little bit of August in there because we're in the midst of rolling right now in terms of volume from August to October. I'll get to that in a moment. Before I jump into the charts, I just want to encourage you to please take advantage of my 2-week free trial. I offer a daily market analysis, very detailed market analysis, very specific support and resistance, trend identifying levels in a broad range of markets that includes, lean hogs, feeder cattle, live cattle, crude oil, corn, wheat, soybean meal, the S&P 500. I could go on. If you haven't had a free trial in at least 6 months, I do offer a new free trial every 6 months, 2 weeks long, uninterrupted. You don't have to give me all kinds of private or detailed financial information. All I need is your name, your email address, and preferably a phone number, so that we can talk during the 2 weeks. I do call you, and then I can answer any questions. We can talk your hedging needs, your trading needs, and see how my work may be able to complement that. There's no, you either like the work or you don't. It either works for you or it doesn't. And that's kind of the way I see it. I don't really sell the work very hard. It sort of speaks for itself as far as I'm concerned. But in any event, let's jump to the charts. This is the weekly continuation chart for the Chicago Board of Trade corn contract. Presently reflects the December 21 contract. This is essentially the stringing together of previous contracts, and that's really the common way to analyze commodity markets. This is a weekly bar chart. We had a buy signal last December in which I had an initial target in the 700, 735. We got to 735. It's actually this high back here at 737. But ultimately, I was expecting 834 and 3/4. If you listen to the show, you know about this number. Now, I went off that target when we settled about a month and a half ago below this rising trend-defining speed line that this week is at 652 even. This 652 even is our ceiling as far as I'm concerned through the rest of the year. Any rallies into the 650s should be considered sell or hedge setting opportunities, because below which I think this market wants to test, if you will, long-term support at 464 and 3/4. Now, lately, the last few weeks, we've been sort of in this quieter consolidative framework. And so the question begs, of course, how long, how soon, if we will actually reach 652 or 465, 464 and 3/4. Let's jump to the weekly chart for the December contract itself. So this is not a continuation chart. This is DEES only. And the way I see DEES shaping up, and by the way, these horizontal lines represent those big picture levels I mentioned and showed in the previous chart. 509 and a quarter near-term support. If we fall to 509 and a quarter, this is a level that could conceivably contain selling through August, and we could remain in this sort of quiet consolidated framework above 509 and a quarter, maybe creep our way up. I call it creeping or grind, move our way up gradually over the next few weeks, and I'll get to that in a moment. But 509 and a quarter, kind of a floor of support through August that, if settled below at the end of this week, for instance, and it is rising ever so gradually, would then indicate this still somewhat targeted 464 and 3/4 long-term support level. That could take 3 to 5 weeks, could take 1 week. 464 and 3/4 able to contain selling through next year. Upside, let's take a look at the charts. Same chart, same DEES weekly chart. We've got 606 half. This is dropping weekly. And so that 509 and a quarter floor to 606 and a half ceiling is sort of our midterm bracketing through August. We could trade inside that zone quite easily all the way through August. And then if we close above 606 half, expect 652 even in a hurry, probably within 1 to 3 weeks, where we can once again top out through the rest of the year, and from here fall back over the following 3 to 5 months into the 464 and 3/4 area. As I mentioned a moment ago, closing below 509 and a quarter would indicate 464 and 3/4 within 3 to 5 weeks or less. I suppose I could say that if we did close above 652 even in the coming weeks, and I don't see it happening, but if so, and this would obviously be just a kind of a diminishing crop quality scenario on the ground in certain parts of the country, that the 834 and 3/4 level then becomes a viable target that would be in reach by the end of the year. But until then, a big picture right now, 652 ceiling, 464 and 3/4 floor, and I do think the market will likely continue south into this lower support area in the weeks ahead. Let's move on to crude oil. I've been mentioning on the show for the last couple of months a strong long-term ceiling of resistance in what is now the 75.46 area. This has changed. It was in the 76 handle just a few weeks ago. I've been mentioning how this channel top can contain annual buying pressures, and now that we've tested it below which, anticipating the lower 60s as our initial target. So that remains in effect, and as of this morning, big sell-off in crude oil. We are closer to reaching this and sooner than I had anticipated, but that's sometimes the way it occurs. 63.87 is the beginning of a floor of support down to 61.89. This is a September only chart, weekly chart for the September contract. 61.89 rising gradually, moves into the 63 handle by early August, and the 63.87 is dropping ever so gradually. So we have a zone of support that is narrowing, making it more conveniently to trade. We could bottom out in the 63.87 down to 61.87 area all the way through August and into September. And once tested, the market could regain upward momentum and rally back, a rebound back into the 75.46 area within a month or two at the most. But because of the significance of this long-term resistance area, I wouldn't be surprised that if over the coming month, 2 or 3, we actually violate this speed line, which would set the market on a secondary bearish course into the lower 50s. I'm not prepared to show that just right now because it's a little premature, but just know that if we violate 61.89 or this rising speed line through time, we have a secondary sell signal that'll play out into later year. Upside, if the market can close above 75.46 by a 1% margin in the weeks ahead, which does not look likely at this point in time, but if so, then we have a 3 to 5 month buy signal into the 93.53 to 95.28 region, where I would expect the broader crude oil market to top out through next year. But right now, just to recapture, 75.46 ceiling through the rest of the year, below which expecting that low 60s. Right here is the start of the zone down to 61.89 that can absorb monthly selling pressures, possibly through September, and if settled below, sets the market on a secondary bearish course into later year. Finally, live cattle. There's a little bit to unpack here because we are in the midst of a rollover from August to October. So this is a weekly continuation chart. The stringing together of previous contracts presently reflects August, but will later this week reflect October because as of this morning, October volume is higher. And so long as that continues on a day-by-day basis through this week, October will inherit this chart, if you will, at the end of the week. 116 even floor of support, mid to longer term in scope, able to contain selling through the rest of the year, and above which, or once tested, the market can move higher, possibly into the mid 130s over the following several months, 3 to 5 months. We could trade inside 116 even to 135.47 through the rest of the year. Now, as I say, October will be inheriting this over the coming days. What is now 119.35 August contract will soon become 124.22 October contract, so it'll jump up a bit. And this is the October chart itself. I still have support at 116 even, FYI, and I might as well draw that right here, right now, represented by a vertical line. But preceding 116 even, which October will inherit later this week as a long-term support level. I'm just letting you know that there's decent support in the October contract at 122.02 this week. We have a decent convergence of two different channel structures at 122.02 that can absorb October contract selling through August, and from here, the October contract can turn higher. So we might not actually test 116 even, this formation, that I'm showing once again here in the October contract, because there's reason to believe that these structures just might contain October contract selling pressures into October expiration, because from here we can turn higher. But if we do close below 122.02, we have just maybe 3 to 5 weeks at the most whereby we actually test this 116 even longer term support on the weekly chart that goes back over a full year of activity. Let's talk upside October contract, that if we do close above 128.45, which I think is a long shot this week, but we could perk up here for the next week or two. And if we close above this descending channel top, which I do keep you apprised of in my daily October contract October contract newsletter, if we close above 128.45, then this mid 130s becomes a 3 to 5 week objective. And just want to remind you, not only do we have long-term resistance in the October contract in the mid 130s, but once again, this long-term chart formation in the mid 130s that October will be inheriting later this week. This formation, 135.47, able to contain buying pressures through next year. So it becomes a real meaningful hedge setting opportunity if we rally into the mid 130s, which will be an easier lift for the October contract because of its present pricing in the mid 120s. So once again, I'm going to show you one more thing here. If we close below 122.02 this week, 116 even, here we come. 116 even is on the weekly continuation chart. And if we close below 116 even in the weeks ahead in the October contract, we actually have ourselves a longer term sell signal that should yield 101.5 by the end of the year for the broader market. I think that's really all that needs to be said. I've unpacked a lot here. You can always hit replay and go back and revisit what I've said. But that's all I'm going to say here for this week's AgriTalk video supplement for the July 19th show.
So do yourself a favor. Fill out the free trial form on this website. Take that 2-week test drive. You have nothing to lose and much to gain.